On January 7, 2009, the boardroom of Satyam Computer Services erupted in chaos as its charismatic founder, B. Ramalinga Raju, handed a handwritten confession that would later be called India's Enron, a $1 billion fraud that shattered a nation's faith in its booming tech sector. Satyam began in 1987 as a modest startup in Hyderabad, founded by a young engineer with a vision to bring Indian software talent to the global stage. In the early 1990s, as the world opened its doors to offshore outsourcing, Satyam rode the wave of deregulation, securing its first major contract with a Fortune 500 American firm. By 1995, the company had gone public, listing on both the Bombay Stock Exchange and the Nasdaq, a rare feat that signaled its meteoric ascent. Investors were dazzled by the company's rapid revenue growth, its sleek campuses, and the aura of its chairman, an engineer-turned-billionaire who embodied the Indian rags to riches dream. The narrative of triumph was amplified by a series of strategic moves. In 1999, Satyam acquired two U.S. firms, expanding its footprint across Silicon Valley, and in 2002 it secured a massive contract with a European telecom giant, propelling its annual revenues past the $1 billion mark. The stock surged, and the company's market capitalization swelled to over $8 billion. Raju's public speeches, peppered with references to building a world-class Indian IT empire, resonated with a nation eager to showcase its technological prowess. Yet, beneath the glossy press releases, warning signs began to flicker. Analysts noticed that Satyam's profit margins were consistently higher than its peers, a statistical outlier that should have prompted deeper scrutiny. In 2005, a whistleblower within the finance department raised concerns about irregularities in the company's cash flow statements, but the concerns were quietly dismissed as minor accounting adjustments. Meanwhile, auditors from a leading global firm repeatedly issued clean opinions, despite internal memos that hinted at pressure to meet ever-higher earnings targets. The board, dominated by Raju's loyal allies, failed to establish independent oversight, allowing the CEO to wield unchecked authority over financial reporting. The first tangible crack appeared in 2008, when Satyam announced a sudden, massive increase in its cash reserves, $1.2 billion, according to the annual report, despite a global slowdown in IT spending. Skeptics pointed out that the cash figure far exceeded the company's actual bank balances, but the market cheered, pushing the share price to an all-time high. Simultaneously, several senior executives quietly resigned, citing personal reasons, a pattern that, in hindsight, signaled an exodus of those who sensed the impending disaster. The facade collapsed on that fateful day in January 2009. Raju's confession letter, typed on a simple office printer, revealed that the company's accounts had been inflated by $1.47 billion, that fictitious cash balances and non-existent assets had been used to hide a series of losses, and that the fraud had been ongoing for years. The revelation sent shockwaves through the Indian stock market, wiping out Satyam's market value overnight and erasing billions of dollars of shareholder wealth. International partners froze contracts, fearing exposure to the scandal, and the Indian government was forced to intervene to prevent a systemic crisis in the IT sector. In the immediate aftermath, the Indian Ministry of Corporate Affairs appointed a new board of directors, including representatives from the government, to steer the ailing company back to stability. The government also facilitated a sale of a controlling stake to Tech Mahindra, a fellow Indian IT giant, in a bid to preserve jobs and restore confidence. While the takeover salvaged the operational business, the legal fallout was relentless. Raju, along with several top executives, faced multiple criminal charges, ranging from fraud and forgery to conspiracy. In 2015, Raju was sentenced to 7 years in prison, though he later received a presidential pardon in 2022, a decision that sparked renewed public debate about accountability and the influence of powerful corporate families. The Satyam scandal left an indelible imprint on India's corporate governance landscape. In response, the Securities and Exchange Board of India, SEBI, introduced stricter regulations, mandating greater independence for audit committees, tighter disclosure norms, and harsher penalties for financial misconduct. Companies were required to rotate external auditors every 5 years, a move designed to prevent the cozy relationships that had allowed Satyam's deception to flourish. The episode also spurred a cultural shift among investors, who became more vigilant, demanding transparent reporting and questioning inflated profit margins with renewed skepticism. For the thousands of engineers who had built their careers at Satyam, the collapse was both a professional and personal trauma. Many were reassigned to new projects under the Mahindra banner, while others chose to leave the industry altogether, disillusioned by the betrayal of trust. The ripple effect extended to the global IT outsourcing market, where clients temporarily reconsidered Indian vendors, prompting competitors in Eastern Europe and Southeast Asia to vie for the vacated contracts. Yet, in the long run, India's IT sector demonstrated resilience, rebounding within a few years as confidence was gradually restored. Today, the ghost of Satyam's rise and fall serves as a cautionary tale, a stark reminder that unchecked ambition, when coupled with weak oversight, can turn a corporate champion into a national scandal. The story underscores the fragile balance between visionary leadership and ethical stewardship, a lesson that reverberates across boardrooms worldwide. Subscribe to The Collapse for more stories like this.